You have $10,000 saved. That is not a small thing. Most people never get there. The average American has less than $1,000 in liquid savings. You crossed a line that the majority of people never will. So here is the uncomfortable part. That money is already losing. Right now, tonight, while you sleep feeling responsible and disciplined, inflation is quietly, methodically, eating a hole through it. Not dramatically, not like a crash, more like a slow leak, a tire that looks fine until one morning it doesn't. At 3% annual inflation, which is roughly where we've been hovering, $10,000 has the purchasing power of about $9,700 by this time next year. You didn't lose money on paper. The number in your account stays at $10,000, but what it can actually buy, that went down. And the year after that, it goes down again, and again. In 10 years, at that same rate, your $10,000 buys roughly $7,400 worth of goods. You didn't spend it. You didn't gamble it. You did everything right, and the money still shrank. So no, this is not a video about saving more. You already saved. This is about what happens next, because $10,000 is not a destination. It is a threshold, and on the other side of that threshold, the rules change. 10,000 is not arbitrary. It is the number financial planners tend to use as the lower bound for what they call a fully funded emergency fund. 3 to 6 months of expenses depending on your situation. For most people living on $35,000 to $50,000 a year, $10,000 is roughly the floor of that range. It is also the minimum threshold most high-yield savings accounts start treating you like a real customer. Below $10,000, your options are limited. Above it, doors open that weren't open before. And it is the psychological inflection point where most people make one of two mistakes. Mistake 1, they stop. They hit $10,000, feel the satisfaction of the round number, and let it sit. They earned the rest. The account becomes a trophy. Mistake 2, they move too fast. They feel like they have real money now, and suddenly they are reading Reddit threads about crypto at 2 in the morning. Both mistakes have the same root cause. Nobody told them what $10,000 actually is. It is not a destination. It is not a launch pad for speculation. It is working capital, and working capital needs to be put to work, deliberately, patiently, in a specific sequence. That sequence is what this video is about. Before you invest a single dollar of that $10,000, you need to answer one question honestly. Is this money actually available? That sounds stupid. Of course it's available. It's your money. But available means something specific here. It means you can lose access to it for 30 days without anything in your life breaking. It means there is no car repair, no medical bill, no busted furnace that forces you to crack it open at the exact wrong moment. Because the most expensive thing you can do in personal finance is invest money you need for emergencies. Not because investments are bad, because the timing will betray you. Markets go down right when life goes sideways. It is not a conspiracy. It is just the nature of stress. You lose your job in a recession. Your car breaks down during a downturn. When you are most desperate, your portfolio is most likely to be underwater. So if your $10,000 is your emergency fund, if it is the buffer between you and a bad month, it should not be invested in anything that can drop 20% in a quarter. It should be sitting in a high-yield savings account, earning somewhere between 4 and 5% annually, depending on the current rate environment. Not spectacular, not exciting, but liquid, accessible, and safe. As of early 2025, the best HYSA rates were sitting around 4.5 to 5%. That is meaningfully better than the national average savings rate, which was still below 1% at most major banks. Same FDIC insurance, same access, just a different institution. If your $10,000 is truly your emergency fund and nothing more, park it in a high-yield savings account, automate a small monthly contribution, and stop thinking about it.
But if you have more than that, if the 10,000 is the beginning of something beyond emergencies, then we move to the next layer. Here is a thing that almost nobody explains clearly. The single most powerful thing about a 401k or an IRA is not the market returns, it is the tax structure. Let's run a simple comparison. Say you are 30 years old, you invest $10,000, it grows at a 7% average annual return, which is roughly the long-term historical average of the US stock market after inflation. By the time you are 60, that $10,000 is worth $76,000. Now do the same math with a regular brokerage account. Every year that account earns money, you owe taxes on the gains. Depending on your bracket and whether the gains are short or long-term, you might lose 15 to 23% of each year's returns to taxes. Do that drag over 30 years, and you do not end up with $76,000. You end up closer to $55,000. $20,000. Gone. Not to bad investments, not to fees, to taxes on gains you paid along the way. A Roth IRA eliminates that. You pay taxes on the money before it goes in, and then it grows tax-free, forever. When you pull it out at retirement, you owe nothing. A traditional 401k flips the structure. You get the tax break now, money goes in pre-tax, and you pay taxes on withdrawal. Better if you think your tax rate will be lower in retirement than it is today. The maximum Roth IRA contribution in 2025 is $7,000 per year. That is the limit. So if you have $10,000 and you have not maxed your Roth for the year, that is the first place any investing money should go. Not because the investments inside a Roth are magical. They are the same index funds you would buy anywhere, but the tax wrapper around them is extraordinarily valuable, and there is a strict yearly cap on how much of it you can claim. Every year you do not max your Roth, that year's contribution limit is gone forever. You cannot go back, you cannot make it up. That is the part people find out at 45 and deeply regret. Let's talk about where most of your money should actually go. Not individual stocks, not sector ETFs, not whatever is trending on financial Twitter this week. A total market index fund. This is not a hot take. It is at this point one of the most well-supported findings in all of financial research. The vast majority of actively managed funds run by professionals with Bloomberg terminals and decades of experience, underperform a simple index fund over a 10-year period. According to the S&P SPIVA report, which tracks this annually, roughly 85 to 90% of large-cap actively managed funds underperformed the S&P 500 over the past 20 years. 85 to 90%. These are not amateurs. These are people who went to Wharton and have research teams, and still, most of them could not beat a fund that just buys everything and holds it. The reason is simple and slightly humbling. Markets are reasonably efficient. When you buy an individual stock because you think it's going to go up, you are essentially betting that you know something that thousands of professional analysts who have access to far more information than you somehow missed. Sometimes that works. Usually it does not. The index fund alternative is different in a specific way. You are not trying to pick winners. You are buying the whole game. When the market goes up, you go up. When it goes down, you go down with it. But so does everyone else. And historically, the market has always eventually recovered and made new highs. The S&P 500 has had 22 bear markets since 1928. It has recovered from all 22. That is not a guarantee. Past performance is genuinely not a guarantee, but it is a pattern worth understanding. Vanguard's VTSAX, Fidelity's FCROX, Schwab's SWTSX. These are all total market index funds with expense ratios near zero. You buy them, you hold them, you stop checking them every morning. That last part is harder than it sounds. Here's the part that doesn't feel inspiring, but is the most important thing in this video. Time is the variable that matters most, not the amount you start with, not the fund you pick, not the market conditions when you begin. The math on this is stark. If you invest $10,000 at age 25 and never add another dollar at a 7% average annual return, you will have roughly $150,000 by age 65, 40 years of doing nothing, just letting it sit. If you wait until age 35 to do the same thing, you end up with $76,000, 30 years instead of 40. That 10-year delay cost you $74,000. You didn't spend that $74,000. You didn't make bad decisions. You just waited. This is called compound growth, and it is the one piece of financial knowledge that is genuinely as powerful as people say it is. The returns in the first few years are modest. They are almost boring, but the curve bends, and by the end, the numbers get strange. Einstein may or may not have called compound interest the eighth wonder of the world. That quote is probably apocryphal, but whoever said it first understood something true. The irony is that compound growth rewards exactly the behavior that feels the least rewarding: patience, inaction, boring. The people who get rich slowly are the people who can resist the urge to do something clever. This is also why starting at $10,000 matters so much more than starting at $50,000 10 years later. The base amount is less important than the runway. Now let's address the part of the internet that is trying to sell you something.